Good afternoon, everybody, and thank you for taking the time to attend the presentation today. What we'll do today is we'll, in addition to taking you through the H1 21 results, we'll give you an overview of the business initially for those of you who may not be that familiar with the business. We'll run through the H1 highlights, and Sue will take us through a bit more detail in the financials, and obviously we'll leave time for the most important part, which is a bit of Q&A. So my name is Alasdair MacDonald. I took up the CEO role as of mid-October, so I'm delighted to present my first set of results. And alongside, as we said, is Sue Hurst, who is CFO. Can I just draw your attention to the normal disclaimer and allow you to read? We will be referring to some forward statements, but obviously you'll all be familiar with the position within as a listed company and the obligation regarding the disclaimer. So a bit of background, since this is my first presentation, delighted to take over from James Ritchie, who left the business as of August this year. And we announced to everybody the change we completed at an executive level. I joined the business, Tekmar business, in 2013 as a non-exec chair, while the business was backed by a listed capital private equity business. Prior to that, I spent 30 odd years predominantly in the energy space, and most recently CEO and CEO of Wellstream Holdings PLC, which was a FTSE 250 company. So I bring a bit of PLC experience to the business. I spent 19 years with the Teklink organisation in various directors, executive roles, and laterally I spent 3 years running the Teklink umbilicals business based out of Newcastle, which is where the Tekmar business headquarters is based. After leaving the Wellstream business and prior to taking on this role with Tekmar at an executive level, I was involved with a number of private equity businesses and predominantly on the manufacturing and engineering side. So I'll let Sue give you a brief introduction for herself.
Yeah, hi there, everybody. So I've been with Tekmar now 8 years. I joined about a year after the original management buyout, which introduced our private equity investors at the time. And the main focus at the time was to kind of improve financial systems and processes within the business. Spent a lot of time looking at that and the commercial governance and risk management, etc. And then obviously led with James the business through the IPO process 2.5 years ago now. Prior to that, I was in lots of PLC, large blue chip organisations at a senior level, looking at mainly project-based businesses with quite complex contracting regimes, and some VC-backed private equity in my background as well.
Thank you, Sue. So first of all, if I give you a group overview for those of you who may not be so familiar with the Tekmar business. We're made up of 6 companies, moving from left to right. Ryder Geotechnical, a recent acquisition to the business, which is predominantly focused on geotechnical engineering analysis, mainly in the energy space. Agile Tech Engineering, our front-end engineering, detailed analytical design consultancy-based business. Subsea Innovation, which predominantly designs, manufactures, engineers bespoke engineering products. Tekmar Energy, the core part of the business, the largest part of the business, which focus on subsea protection systems, predominantly in the offshore wind market, so polymer-based products where we engineer, design, and manufacture the product. Pipe Shield International, which was a recent acquisition, subsea protection products based out of Lowestoft in the United Kingdom, and a subsidiary in the China market based out of Shanghai. Overall group's turnover is circa 41 million as of the end of FY20. We're in 17 locations worldwide, circa 200 employees in the group, and over 35 years of experience. So we feel we've brought a group of companies together now that have synergies in terms of the product offering, complementary offering to the customers, and we're seeing more and more now of combined selling to customers, which kind of shows that the strategy is coming together. A bit more detail in terms of the product range. We've got the geotechnical design and analysis group within the business, and we focus on foundation design, mooring analysis, jack-up analysis. So really looking at the front end side of the business, and particular relevance as we see the development of the offshore wind businesses, particularly going into deeper water floating technology, and I'll talk about a bit about that later on. We've got the engineering analysis for the installation of the subsea assets, software design, dynamic installation analysis, installed analysis, risk analysis, and conceptual design and analysis for the protection of the subsea assets. Under subsea innovation, we've got bespoke equipment design and build, so a very strong capability in terms of engineering know-how within the business, as demonstrated by a slide that I'll show you regarding deployment of a pipeline lay system, which we recently delivered for an installation contractor, which is now working laying pipelines in the Gulf of Mexico. The core products under subsea protection in terms of cable protection, dynamic bend stiffener, soft products, bell mouths, hang-offs, etc. Predominantly the polymer-based products, which is a core business within the group. And then we've got the asset and protection and subsea stability solutions that we've brought in as a result of the acquisition of Pipe Shield, which has been integrated well into the business, is performing very well for the group overall. So delighted with the addition of Pipe Shield to the group. If we look at the application of our assets, and we are deploying assets in the subsea water column. If you look at the assets deployed here, if you look at the yellow systems, in terms of cable protection, and we're showing here a typical installation for an offshore wind farm where we have a structure supporting the wind turbine, which is located on the seabed, what we'll call a static subsea system. If you look at the cables laid on the seabed and the various products that you've got on the cable here, from cable protection system, J-tube seals, pipe separation equipment, bend limiters, stability products for the stability of the cable on the seabed, concrete products for protection, for pipeline separation, emergency pipeline clamps, repair clamps, bell mouth assemblies, etc. And if you look, as we move to the right-hand side, we're moving more into the newer developed products, which will come in as a result of floating wind farms, where we're showing the yellow structure on the top right-hand side, which shows a floating wind turbine. And you're seeing the cable entering the wind turbine. And by its nature, you'll see that this is a much more dynamic type of product. So as we move forward into the floating wind technology, we see the evolution of our technology into much more dynamic nature. And we're going to move forward with the investment in some of these products as we see the evolution development of floating technology. And I'll talk to you a bit about that later in terms of timing of that technology development. In terms of the floating wind solutions, it's an exciting area of the market that I think is well suited to the product portfolio that we've got within the business, from buoyancy assemblies, subsea protection assets, clamp assemblies, cable protection, buoyancy products, geotechnical products, analysis of the geotechnical installation of subsea piles, mooring clamps, etc. And also not to forget the products that we design and install from the deck of the vessel, the deck equipment technology that we've seen as a very successful part of the business. So overall, an exciting development in the sector that we think we're well suited to develop and support. In terms of geographical locations, our headquarters is in the northeast of England in the UK, based just south of Newcastle at our Newton facility. We have a facility in Darling facility as a result of the acquisition of Subsea Innovation. Ryder have an office in the Newcastle facility. Our Pipe Shield business has a base in Blyth and in Montrose in the UK. Pipe Shield is headquartered in Lowestoft, and we have our Agile Tech business headquartered in London. We also have the subsidiary based out in China and Shanghai, and we have various representation and sales agents located around the globe. And I'll talk a bit more about the evolution of the geographical split as the market is growing and how we plan to cover the geographical spread and increasing geographical spread of the offshore wind market. So we operate in 17 locations across 12 countries around the globe. If I take you through the highlights for H1, and if I look at the financial highlights to start with, our revenue was at 15.2 compared to H1 20 at 17.1, so 1.9 million variance like-for-like period. Predominantly driven by what we're seeing is the impact of COVID, as we're seeing projects are being delayed in terms of the conversion and order intake. But pleasingly, we're not seeing projects being cancelled. What we're generally seeing is a compression of the execution phase with a lot longer time intake in the negotiations up front. What we're seeing there really is largely as a result of this compression, a need to review the back-end data, mitigate liquidated damages exposure. That's translating into a longer period of negotiation at the front end, and obviously capacity requirement to maintain capacity for that delayed compression, as I call it, the schedule is one of the critical issues we're seeing in play going into the next calendar year. EBITDA finished at 800k versus 2 million H1, just a translation of that delay that we're seeing in the market at the moment. Our closing cash finished at 3.6 versus 3.9 for the same period. And I'm pleased to see that our H1 offshore wind revenue was consistent with our H1 20 revenue. We also noted that we've extended our year end to September 21. It's an area we've been looking at for some time now to alleviate the congestion that we're seeing in the March-April period, where we're seeing a lot of our volume coming through the facility was due for delivery around about that time. So we think that will give us a smoother transition in terms of cash projection, cash flow, etc., which makes it easier for our year-end forecasts into the market. And pleasing to see that our inquiry book finished up 21% at a healthy 225 million. It's really supported that we're seeing the market is still very strong in terms of quoting, but we're just seeing this lag and inertia in terms of delay, in terms of converting the orders, which we think will start to unwind as we get into the next calendar year. And we're beginning to see a lot more traction now in terms of discussions regarding order conversion. In terms of market highlights, this is probably the key highlight for the presentation. It's all the indicators point to growth in the market on a global scale in offshore wind. Our global offshore wind forecast over the next decade is projected to increase from circa 29 gigawatts to in excess of 233 gigawatts. But pleasing to see that we're seeing real traction around that projection now. A lot of political drive coming into this sector and supporting the transition towards green energy. So we're very excited that we're now seeing some real movement in terms of the real scaling up of this sector. UK capacity is forecast to grow fourfold over the decade from a current installed capacity of circa 10 gigawatts to about 40 gigawatts. And we're seeing more and more discussion now on political drive towards local content. This is an area that's been talked about numerous times in the sector, but hasn't really been measured. And I think for the next wave of projects going through, we'll see more and more drive towards local content. And we think with the cluster of businesses we've got in the northeast of England here, we're well positioned to capitalise on that drive, and I think it suits the group well in terms of the core business that we are based in that region. If you look at the European data, likewise, we're seeing a significant increase there from a current installed capacity of circa 12 gigawatts, increasing to about 60 gigawatts by 2030. And if you look at drill down in terms of the short-term projection, between now and 24, 25-ish, we see an 18.6% CAGR for global offshore wind growth. So overall, indicators are really supporting the continuing maturity of this market. And as a result of that, our core focus and our growth is very much going to be around the growth in the offshore wind market, and that's our key market historically, and it's going to continue to be our key market going forward. If we look at our operational highlights, I'm very pleased to comment on the LTI-free days. This is a key measure for our business, and largely, if you see a good safety performance in a business, it translates into a very good culture within other areas of the business, from quality to financial to operational. So I'm pleased to see that 3 of the businesses have best-in-class performance. One business with 7 years LTI-free, second business 3 years LTI-free, and a third business, Pipe Shield, 5 years LTI-free. These are best-in-class industry standards, and I'm delighted to update them every on the data there. And a key element for us as an executive team to measure ourselves against. Over the period, the key priority obviously has been the well-being of personnel. As we all know, there's been a lot of disruption to our operational side of the business. I'm delighted to see the way the team has responded. It's impacted our productivity regarding home working, less people in the office, spreading people out in the factory, making sure that we're maintaining social distancing. But I'm very pleased with the response that we've managed to maintain all deliveries to customers through the period, which is a great credit to the team and their flexibility to adjust to the unusual circumstances we're in at the moment. The key issue we're seeing, obviously, delay in order intake. There's an inefficiency in the market just now, but I'm pleased to say that we're beginning to see progress towards that inefficiency evaporating in the market. And I think over the next few months, we'll see a lot of the backlog converting. And so we're all geared up for that move into the next calendar year. We've taken the difficult decision as a result of this ongoing delay to reduce our costs in the business. We've reduced our headcount by circa 6%, and we've introduced an efficiency in our manufacturing capacity, and that's allowed us to remove circa 25% in our manufacturing capacity. In round numbers, we had about 120,000 square foot for our core products in the offshore wind market. We've removed 30,000 square feet of that capacity. In an ideal world, we'll be looking between 60 and 70,000 square foot capacity. So having 90,000 square foot still gives us plenty of capacity for what we're projecting over the next mid to long term period. I'm pleased to see that our offshore wind revenue has been maintained at a healthy 66% of overall group revenue. If we look at our strategic highlights, very much our focus, as I've said previously, is growth in the offshore wind market. It will remain our core market as part of the strategic plan going forward. We're focused in the short term on the group integration and reorganisation of the business, and largely to date, we've still run the acquisitions as they were. We've taken the opportunity now to move into the integration phase. We've introduced a matrix organisation to try and synergise as much as we can the businesses. But I have to emphasise we've gone with a relatively slow pace there to make sure that we get real engagement from the acquired businesses. Because one of the things we've got here, we've acquired largely lifestyle businesses, and we've got to make sure that we retain the domain knowledge and the benefit we've got from these businesses by avoiding moving too quickly and ensuring we engage the commitment from these acquired business to buy into the group growth plan we've putting in place. We're excited with the introduction of the Generation 10 cable protection system, which introduces an alternative solution for our customers, where we add an evolution of our TEKDUCT technology in addition to our Teklink technology. And we've already sold this into some of the projects that we're delivering for next year, and we're beginning to see some good traction in the market regarding customer engagement for the Gen 10 product, which will be well suited as we move into deeper waters, more dynamic environment. So it's an exciting addition to our product range. We see further growth in the offshore wind CapEx market. It's not a surprise to see now that we've got this mature basin and maturing asset base in offshore wind technology. And we see more and more requirement now going into the OPEX side. We've been working successfully on one project this year, which will continue into next year. And we think our technologies are well suited to address a more focused approach to support the OPEX after sales side of CapEx market. And, it's going to be a key focus for us going forward. And the board appointments, I'm delighted to take up the CEO role following James's success with the business. And I'm delighted to see that Julian Brown has taken on the non-exec chair role from his non-exec director role, which leaves one a role in the board to fill, which we'll do over the next few months. And we're not in any particular rush to make that appointment. We'll do that appointment when the time is right. And I'm delighted to announce the appointment of our second joint broker, N+1 Singer, who have already started supporting us in the business and have engaged very well alongside Berenberg, our initial broker. So I would say the key headline to leave with you is that the long-term fundamentals in the offshore wind market are very compelling and will remain the key focus for the Tekmar Group of businesses going forward as we develop our strategic plan over the next couple of months. Looking a bit more detail at the Generation 10 product, this is an evolution of our Tektube product, which, as I said previously, is an extension of the existing technology. It also is well suited to the application for deeper water products. And the cost saving to the customer is a circa 30% cost saving, so I think this positions us well commercially and technically, and allows us to kind of keep a dominant position in the marketplace. And from an installation point of view, there is also a saving to our customers. So overall, the rationale and the strategy behind the Gen 10 product is quite compelling, and it addresses technical requirements, thermal requirements, and we think it's a good fit for the business going forward. We are doing some ongoing trials and testing as we introduce this product into the market going into the next calendar year. If we look at our order book and our order intake, our order book finished at 10 million, in line with where we finished FY20. Our order intake finished at 15.2. And, I think reasonably happy in terms of the book to bill sitting at an index of 1, considering all the delays, the ongoing impact we've had in terms of order conversion. And some of the highlights there, we're seeing 2 new offshore wind contracts in China, first major project awarded in Japan. Pleased to see a new project in Saudi Arabia and the Middle East, and continuing development of CPS, offshore remedial works, as I talked about before, is that's development of OPEX side of the market. And we're particularly excited to kind of see the opportunity in that sector. If I could jump now to the market overview, I think key headlines regarding offshore wind. We're seeing this very much as a mature and maturing market. We see a real driver towards investment to support greener sources of energy, of which offshore wind is a key factor. If you look at the UK government's 10-point plan that came out 2 weeks ago, the first key point in that plan related to offshore wind and the drive towards this quadrupling of capacity over the next decade. And pleasing to see the commitment to some investment to support that development, £160 billion investment announced by the government, largely to support the development of ports, logistics, manufacturing facilities, which we think the northeast of England is well suited to support. If you look at the growth that we're projecting, that 230 gigawatts of planned installed capacity, that requires a step change going forward in terms of facilities. To date, we've generally developed offshore wind in shallow water, and shallow water we've classed historically as up to 60 metres, although we now see 45 metres and upwards being termed as deeper water. 70% of the planet is covered by water, and hence kind of drives the need towards developing into deeper waters than what we have done today. And the reason offshore wind is such a compelling solution for offshore wind is there are more consistency in terms of wind speeds, etc. and it's being seen as a sustainable and clean energy source. If we look at the projection on the installed capacity, we've always seen a drive towards increasing capacity, but what we're beginning to see now, if you look at the statistics on the right-hand side here, the 3 bars, between March 19 and to September 20, we're seeing a plateauing now at the 225, 220, 230 range of gigawatts. So that's kind of giving us a bit more confidence now of sustainability of the growth projected on a global basis. And this shows a 7.9% market increase since our update mid-year. And I've talked about the CAGR development and some of the kind of sub-elements previously. If we look now at the change we're seeing, what we're representing here in the 3 graphs here, 3 pies. On the left-hand side, you see the existing installed capacity. The middle pie, you see the current ongoing installation projects. And the right-hand side, you see the future planned capacity. And if you look at the left-hand side there, you see the split, the dominance regarding the UK market, the China market, and the German market. As we move to the right, you'll see much more of a geographical split, and you see the development there of the US market coming more into play. If you look at that geographical split, I'm pleased to say that the Tekmar Group has supplied the core products into each of these countries today already. So we think we're very well positioned to support that geographical split. So as we see the change over the next decade, we'll see much more of a wider geographical footprint. That will result in us changing our strategy to have partners, joint ventures in place prior to installation of facilities or supporting facilities in country. We want to really see some traction and local investment before we repeat the model that we've got in China, where we're in country, because we can't cover every geographical region, but we want to be present in all the key regions. And I think what we're seeing in play as well is an internationalization of the European lessons learned over the last couple of decades regarding development of offshore wind technology, not just from a developer point of view, but also from the installation contractor's point of view, as well as the supplier's point of view. So we're quite excited regarding that internationalization of European know-how alongside our key customers and partners. And if we translate that into an addressable market, what we've shown in this slide is the scale of the addressable market for the Tekmar Group technologies as we have them today, covering cable protection, geotechnical, asset protection, subsea masters deployment, etc. And we see a very conservative 120 to 140 million range in terms of the addressable market. And that's before we talk about any further development in the technologies, which clearly we're going to do, the likes of the Gen 10s coming in, the deeper water technologies coming in, the scaling up of the technologies that we're going to require for the offshore wind, particularly floating technologies, which will scale up in terms of size, but obviously reduce in terms of volume because the number of cables will be less going forward. Floating technology is only really going to come into play mid-decade, we think. We're beginning to see some exploratory projects, trial projects taking place today. So fairly low quantity in the first 5 years, we think. We have some of our businesses like Agile Tech already working on some of these floating technologies at the early stage in the conceptual phase. So we think we've got the time now to evolve and develop the technologies quite nicely with that kind of growth projection that we're seeing taking place. And if you look at some of the emerging markets, obviously China, very dominant already. We've got a strong position in the China market. We think over the decade, China will plateau out. We also think that China is a short to mid-term strategy for ourselves because we think localized suppliers will develop in that market. What we see in China is keep trying until you're successful. And that will saturate the market, I think, for external companies like ourselves. And, obviously, we'll see the growth elsewhere. Pleased to see the United States now starting to show some traction. I think the new administration coming into the US market is positive. And the scale of the opportunity in the US market is substantial. It is very strong from our legislation perspective, so that will naturally bring a bit of a lag in the US market as it develops. But we're going to align closely with our existing customer base who are going to have a strong foothold in that US market. Japan, another growth market where we're active today, showing an increase to 8.4 gigawatts. And then it goes on to South Korea, France, Taiwan, etc. And a lot of these markets we've already supplied into. And there are other developing markets like the South Americas, Portugal, Spain, etc., which will have specific localized strategies developing. Brazil market will come good in time. It's very, very early days of the Brazil market. So, a lot of exciting opportunities around the globe that we can align with our strategic plan. And looking at floating wind, I've talked about this before, a lot of coverage in terms of floating wind technology, quite a lot of challenges still to overcome with the floating offshore wind technology, but this will come into the market more and more over the next decade. And we want to be positioned to capitalize on this, and some experimental projects in the early stages that I talked about that we will be part of to develop that technology for the future. And if we take a look at the offshore wind CapEx market, spend in the European market, and we see an inflection point around about mid-22, where we see the CapEx spend in offshore wind overtaking the projected CapEx spend in oil and gas. If we look at some of the balance sheets and the market capitalization of some of the larger players, we're now seeing offshore wind dedicated developers having a market cap larger than the likes of ExxonMobil, the BPs of this world. And I think that is, it's amazing how quickly that kind of evolution has taken place. We're seeing the traditional oil and gas players moving more into offshore wind. BP, the Shells, Eni just recently committed an investment into Dogger Bank. So I think the indicators are all very strong in terms of supporting this trend. And, we'll still sell products into the other energy spaces as demand comes in. And if you look at adding these two ranges of CapEx, if you add the two together, we almost get back to the same level of CapEx that we had in the good old oil and gas days pre-2015. So I think all the indicators are there that our technology is well aligned to CapEx demand going forward. And if you look at our growth strategy, now that we've completed the relatively straightforward integration process, reorganization, structural elements that were needed in the business, we're now going to move on to a deeper dive in our strategic plan. And we'll focus on organic growth, accelerating a growth strategy, and continue with acquisitions. So our focus very much is on developing the technologies in the offshore wind space. I feel we just need to make sure that everybody is absolutely clear on that point. And we will still be looking at, in the short term, for niche technology bolt-ons like we've done in the past that are complementary to our existing technologies. Any gaps that we identify in terms of the transition into the deeper waters, we'll be looking at supporting that through acquisitions. And that generally will be the direction we'll go in the next 2 to 3 years. That's not to say we want to look at larger M&A opportunities. If there are larger M&A opportunities that come that we need, we will have a look at them. But we're very much looking at the internal efficiencies, operational efficiencies in the business whilst we add some of these niche technologies to the business model. So that's a key focus for us going forward in the next year or so. And with that, I'll hand over to Sue to give us an overview of our financials.
Okay. We'll take a look at the high level. There's a bit more detail in the actual announcement that we put out. As Ali's already covered, revenue down in the half year to September 20. but the offshore wind element of that was sort of comparable to the similar period in the previous year, half year, and really pleasing that all of our subsidiaries are now working in offshore wind, so all generating revenue in this space now, which is sort of the original strategy to bring them into the offshore wind space and be able to deliver some of their products into this element. So that's really pleasing. At a gross margin level, the level of returns percentage-wise are pretty much holding there, consistent. Obviously disappointing that down at the profit level, the lack of volume in comparison to the previous half-year period is hitting the bottom line in terms of profitability. And as Ali's explained, you know, the short-term impact on the business is reflected in the results from this half-year. There is a few sort of one-offs in this period just to point out as well. So in amortisation, we have some additional charges in this period relating to the purchase of Pipe Shield, which wasn't in the comparable half-year period last time, and also a credit back on share-based payments relating to some share-based payment options relating to James Ritchie, CEO, who left the business, and those options lapsed, so they reversed back out. Moving on to the balance sheet. The main area of focus is always in our business, as being a project-based business, the main area of focus is always on working capital. We still have quite a bit of cash tied up in our working capital. I tried to put a bit more information about this into our announcement this year. So this is around the trading of the receivables, which have quite a high level of accrued income sat within them. But this is a rolling balance that is quite normal for project-based businesses that have lots of high-value projects with small amounts of payment milestones in there. So we do get a build-up of accrued income rolling through the numbers. Just want to reassure people that this is not all balances sat there not being paid or not being converted into invoices. It is a rolling balance, and it is looked at by our auditors. Although these aren't audited results, we do have the auditors come in and provide an interim report to the board on a half-yearly basis, and obviously a focus for them is revenue recognition, accrued income and trade receivables, and the recoverability of the same, which they confirm and they're happy with too. In the cash line, we have 3.6 million in the bank at the end of the half year, and that did include a £3 million CBILS loan that we took out in April when the government launched the schemes to help businesses through this pandemic situation. That's repayable in April 21, but we are discussing with the bank whether we should roll that forward and use the benefit of that over a longer period. So we'll be looking at that next year. And what you can see in the cash flow statement is really the reflection of the movements in working capital, how lumpy these can be. So really big movement in trade receivables and debtors moving positively in this period, in the half-year period, but outweighed by the fact that the creditors have unwound in the period too from the previous cut-off at the end of the full year 2020. And this is just reflecting the amount of seasonality in the business and the amount of work that goes through the businesses at the year end or the old year end in March 2020. It was a busy period, and the unwinding of project costs is reflecting in this cash flow statement. So as Ali mentioned, we're moving to a September year end. So for this period, the year end will be 30th September 21. We'll have another half-year period. We'll be reporting interim results again at the end of March.
Thank you, Sue. So, with that, if I can just draw a conclusion overall, I would say great space to be in. We think this is a continuing growth market as we've seen in the market outlook. I think with the fundamentals in the business as well as the market are very strong. We're very excited about the future here. We think it lends itself well to the existing technologies and the technologies we're looking to develop both organically and through acquisition. And we think with the organisation, with the changes we've made, we're better positioned to address that opportunity in the market. We maintain capacity in the business for the growth we're seeing going forward. So we think we're well set up to continue to be a key player, particularly in the offshore wind market. So with that, we'll move to the Q&A session.
Thank you very much. We have loads of questions, so I will kick off with the first one, which says, please could you describe in detail your revenue recognition policy and how assets flow through to contract assets, trade receivables and cash, and how this has changed in the last 18 months?
Okay, so I'll pick that one up. There's nothing actually changed in our processes over the last 18 months. There has been and always will be sort of large project milestone based contract revenue recognition. So the way it works for an offshore wind job is we would get paid over a number of milestones, normally only say 5 milestones for that job, and there'll be a main construction milestone in the middle, which can be up to half of the value of a project. And how it works is obviously we'll start with engineering milestones at the beginning, get design approval from a client. We'll be invoicing at that stage. We'll move into manufacture. We'll do the manufacturing of products, invoice at that stage, and then we'll have some trailing milestones at the end, which are around delivery and maybe final documentation, or even out to installation of the product, although we don't install the product. And then what can happen is you could get change in these contracts. So if a client, once we've already got through manufacturing, decides they want to change some of the deliverables, the contract allows them to give a variation order. That's a very good thing for us in terms of getting more revenues through and more profit through. But what that often does is lock up the cash even further, because the clients will only pay at the end of the changed milestone. So what you have is ongoing balances sitting in contract assets for a while until we can get invoices out. The good thing in terms of the kind of construction type of contracts that we work under is they're very it's a well-trodden path in terms of payment applications and invoicing. So there'll be an application process that'll be approved by the client. So by the time we do invoice, it's very certain that we'll be paid. There's never a lot of trailing debtors in our book or aged debtors over any great long period of time because of this.
Thank you. And how does the trend for the installation of a fewer number of larger windmills to generate the same power impact Tekmar?
Yeah, that's something I kind of touched on earlier. As we see the much larger wind turbines coming in and the larger structures, they'll be dominated by much larger cable, much larger facilities, circa growing from 4 to 8 to 16 megawatt capacity. So that will push it towards a lower number of cables. It will push more technically demanding requirements, or larger technologies that are well within our capability, but lower number of cables to be protected. And that's where we will evolve our technology. So we are diversifying more into the offshore wind space with more technologies that will support our revenue growth. So that's a transition that we see coming in more and more mid-decade. And, we think we've got the time to develop that strategy. And that's, one of the key components that we'll be addressing in the next phase of our strategic plan, where we have a much deeper dive into current technologies and future technologies, and we'll be mapping out our CapEx spend to support the investment in these technologies, both organically and through acquisition.
With the inquiry book up 21% in a growing market, the company is likely to need significant working capital to fund future growth. However, the company only had 2.2 million of cash at the 30th of November and now 3.1 million of debt following the Sybil's loan. How will the company finance this growth?
So the development we're looking at over the next couple of years, we see we'll fund that on the back of the existing balance sheet and through our own existing lending facilities we've got. As Sue has touched on, we've got a very good relationship with the bank. That CBIL facility, which was put in place for a particular reason, we think we can extend that to support the business further. So clearly that the COVID impact has gone on a lot longer than anybody ever anticipated, and we've had a fairly comfortable conversation with the banks to date, and we were going to leave that detailed conversation until we finished our interims. If we do something big, obviously we'll need to go and raise capital, and I think that will be beyond the 1 to 2 year timeline we've got. And that really will be supported by the growth that we'll project over the next 1 to 2 years. So we think we've got a nice roadmap that will support the growth investment we have planned.
Thank you. You describe acquisitions as lifestyle businesses. What do you see as the opportunity to take lifestyle costs out, and how does that work with any earn-out mechanism?
Yeah, so earnouts, we've cleared the earnouts or deferred payments that we've got through the acquisitions. We're now moving into the incentivization plan, which we will align at a group level to motivate the leaders to make this transition into the change from lifestyle to growth strategy. I've quite a lot of experience now in terms of acquiring small niche technology lifestyle businesses and how you can transition and maintain the domain knowledge, the people knowledge within that transition plan. So we've completed quite a bit of that integration process already. As I said previously, we'll move at the right pace to maintain the motivation of the people, and we'll get more and more synergies out of that process as we move forward. So to date, I'm pleased to see the alignment, the buy and the drive from all the acquired businesses towards that goal. So I think it's an open door as opposed to any resistance that we're seeing, because I think we're doing it the right way.
Thank you. And do you have any defensible IP in your products? And does cheaper product from China threaten your worldwide markets as well as in China itself?
Yeah, we protect all technologies in the business wherever we can, because that's like a key control measure for us. We do the same in China. What value it has in China is up for debate. But we do see competition in the China market that is very similar to ours. We will protect that in China. But as I said, it's questionable as to how much value that has, but we've done the right thing by protecting that technology and that IP, including the China market. We do see China as very much a domestic market, a commoditized market, and we sell the simpler product into the China market. We think that's got a bit of a shelf life. We think the Chinese domestic market will try, fail, and eventually succeed. And that then will kind of reposition our drive to the China market. But that dispersion geographically will go through quite a change over the next 5 to 10 years. So we're relatively comfortable with that kind of migration of the geographical split and the different technologies required, and particularly the higher end technologies that will come into the likes of the US market, which is more aligned to the European type market. So we think there's quite a nice spread in the demand coming forward as we move into the next 3 to 5 years.
Thank you. The company's used 4.4 million of invoice factoring in the period, which is off balance sheet due to customer guarantees. Is the scope for this to be increased further to fund the growth?
So that isn't invoice factoring. The 4.4 million is bank guarantees that are customer related as part of our contracting regime. A number of our customers ask for performance bonds or warranty bonds for delivery of the project. It's not a cash invoice discounting regime.
Thank you. And does the outgoing CEO have a lockup on their shares?
No.
No.
I'm pleased to see that the outgoing CEO still holds a significant shareholding in the business, and is very much still aligned with the business, and he's very interested in terms of support in the growth of our business. He's got a lot of knowledge of the business, remains very close to myself, Sue, and the team, and is continuing to support the development of the business. So I'm very pleased and thankful for the support that James is continuing to offer us as a team.
Thank you. 34% of your business is not offshore wind. Can you say more about the prospects for this still large part of the group?
Yeah, we'll be niche in this area, and it's not just oil and gas. I mean, oil and gas probably is a fair proportion of it, in the kind of 15-20% range. We've got marine civils, consultancy, geotechnical in areas outside the offshore wind space within that kind of 30% range. Oil and gas, to me, will come through a bit of a transition over the next 1 to 2 years. We see quite a lot of bidding still going on, but little conversion. That's will build up and will release at some point. So I think there'll be a bit of a mini bubble in the spend in both CapEx and OpEx for oil and gas over the next 1 to 2 years. We want to be part of that. But I want to leave a very simple message with everybody that our focus is very much in growing in the offshore wind space, and where we've got complementary technologies that we can sell into adjacent spaces like oil and gas, like marine civils. We will pursue attractive earnings contribution to the business.
Contract assets again. To be clear, what proportion typically gets invoiced within 6 months, and what is the trend here?
So within 6 months from signing a contract, this really depends on the delivery schedule for a project. So going back to the typical offshore wind project, if we sign a contract to deliver products, it's normally about 4 to 6 months before we actually get to the manufacturing point, because we'll sign a contract and we'll move into engineering process and a design verification process with the client. And that can be a process that takes 3 to 4 months in its own right. And that tends to attract around 30% of the invoicing milestones. And then the manufacture only happens after that first step is completed. So we could be moving into manufacture 4 to 6 months after signing a contract. And obviously invoicing at the end of that would be another couple of months before any cash came in. So it is quite a long working capital process on these projects. But it is, this is what we are used to handling and used to doing, and we do handle our working capital. We are used to these big lumpy projects, and we handle it, and the relationship with the bank, if we need their help, we'll get it. But we are pretty self-sufficient in most regards on that front.
Thank you. And a question on offshore wind industry generally. Recently, Avangrid has changed WTG supplier for an offshore wind farm in the USA from Vestas to GE. Does a move like that also trigger a change in the cabling, etc., that impacts companies like Tekmar? I think this is kind of, as I would say, normal in a growth market. You're seeing the evolution of new technologies. You're seeing change in ownership. So it's quite a dynamic market now that we're in. And not least the kind of E&I investment, as I referenced earlier, over the course of the tail end of last week. We're kind of journey agnostic in terms of whose cable we protect. All we're really interested in is extending the life of that facility for the life of the project.
well positioned with just about all the cable suppliers, have very strong relations with all the cable suppliers. We've got strong relationship with installers and the end developers. So that's, for us, it's what's important for us is intel, early engagement, strategic planning with the purchasers, whether that be the developer, the installer, or the cable supplier. As this market grows, that'll stretch us more and more, and we have to resource and address our key account plans with key customers. So for me, it's a natural migration of the market, that type of transition, and we have to be flexible and adaptable and agile to change with that development. And it's one of the areas that we're addressing within the team now as part of our new organisation structure. And it clearly presents a challenge, but it also is an exciting opportunity for us.
Thank you. And as Sue says, gross margin appears to have stabilised. However, this is still at multi-year lows. What's the company doing beyond cost cutting to improve gross margins?
Well, you've seen the introduction of the Gen 10 product. We've seen a kind of reduced volume over this half. So we're addressing an improvement in terms of volume in the market that supports the cost base we've got in the business. We've been very careful. I have to emphasize this, is probably something I didn't touch on, was even though we've cut some heads in the business and we've addressed our manufacturing capacity, largely what we've done is we've removed excess fat. We haven't cut into the muscle. We could have cut more from the business, but we want to maintain the core offering across the business: engineering, technology, operational, manufacturing, finance, etc., so that we are ready for this increase that we think we will see coming back into the market through the course of next year. So that all plays into improving the margin position further. And we think the market can withstand the level of margin we've had historically with this larger market that we're seeing, even though there's more competition coming in. As I said previously, we think that competition will be looking for returns because they're having to invest quite heavily to develop the technology and the products. So I still think it's a fairly healthy balance we see in the space going forward.
Thank you. And do either of you have any shareholding in the company?
Yeah, my shareholding is circa 430, 450, somewhere in that range, 1,000 shares. And Sue has some shareholding in the business.
Yeah, I've got about 270,000 shares.
Thank you. Currently, wind turbines look to have a life of around 20 years. Do the cabling and associated parts have a similar life?
Yeah, absolutely. And that's, one of the key offerings that we've got for our core cable protection system. It's, if you look at it, we're effectively the real insurance policy. These cables are designed for 20, 25 years. Our protection product is a key part of enabling the cables to last for that period of time, where we're controlling the fatigue loadings, the fatigue stresses in the cables as they enter the subsea structure and subsea assets. And if you look at some of these products, in some cases multi-billion-dollar developments, these cables are a couple of $100 million worth of investment in cable technology. We're a relatively small part of that pie. Our cable protection system can range from $200,000 to a couple of $1 million. So it's a relatively small element, but a critical part of the longevity of the life of field of the overall development. So we see ourselves as a key component to support that design life period that you referred to.
Thank you. And how does the company ensure it's not exposed to large warranty liabilities, given that its products are in use in demanding environments for decades?
Well, that's really down to what I just talked about previously, which is the investment on the engineering technology, the R&D side. So a lot of development goes into understanding the product before we introduce it to the market, so that we've got a good awareness of the risk. And then we've got the ongoing discussions regarding individual contractual liabilities. And it's one of the areas I referred to previously, where we're seeing a delay in the conversion, compression of the execution. We need to be more aware now in terms of the contract risk we're taking there, particularly the back-end delivery dates, and limiting our exposure to liquidated damages. Because the easy thing to do just now is to just take these contracts on and hope for the best. We will not do that. We will manage the risk at the back end as much as we manage the risk at the front end. So a lot of detail goes into that project management, engineering discipline, etc., to mitigate these warranty risks. And yeah, I think we've got a very good process in place to manage that.
Thank you. Do either India or Indonesia feature in any part of the future plans?
Yeah, both do. And as I mentioned previously, we've got lots of areas around the geographies that, we don't even have all these data, other than they're all lumped as other. And there'll be separate discussions ongoing. In fact, we're in discussions on a daily basis at the moment regarding development of offshore wind in India. It's further down the road. And there are lots of other areas, including Indonesia, as you referenced. There's Portugal, Spain. Floating technology is already being developed in Portugal. So there are lots of other areas to focus on in addition to the core ones we've identified today.
Thank you. And what would the impact of a no-deal Brexit be on your business?
That's a good question, actually, and it's one we debate long and hard. We're mitigating that through our project execution phase. We're looking long and hard with our customers at our planned deliveries over the period from now until early part of next calendar year. We're assuming some kind of deal will be done, but in the event of no deal, like we can only control what we're in control of, whatever it means in terms of economy, sterling, exchange rates, etc. We'll have to respond very quickly to if that no deal risk comes into play. Very much it's all geared around some kind of deal will be done, we think, but the next 3 or 4 weeks will play out, and we'll be able to respond very quickly if there's something different we have to do in terms of existing contracts, and particularly new contracts that are about to fall.